All right, welcome to the Financial Shepherd Happy Hour. That's the right sound here. It's Friday, 4 o'clock p.m., St. Patrick's Day, March 17th, and very exciting week here in the markets, no doubt. With the SVB bank failure, Credit Suisse having all kinds of issues. A lot of investors are worried about bank contagion, but we also have some fantastic inflation reports that came about, and actually a very strong week performance-wise for the overall markets, in spite of all the contagion fears that are going on out there related to the financial services industry. So, really, what we want to be able to do today is give you a quick recap of the week, what happened, why did it happen, a little bit of my thoughts, and then certainly looking forward to next week with a very big announcement on March 22nd from Fed Chair Jerome Powell. So basically, in the week here, we had coming into Monday, Silicon Valley Bank failure, and subsequently going through bankruptcy as we are talking right now. Although the United States government decided to go ahead and back all the depositors, even above and beyond the $250,000 FDIC insurance limit. And on top of that, we had Credit Suisse on Wednesday, coming out with their issues as relates to liquidity for their depositors. And again, later that afternoon, the Swiss bank announced that they would provide a liquidity to Credit Suisse depositors, essentially making them whole and guaranteeing, their deposits are still there. So in spite of all that, the financial sector got absolutely creamed this week. The energy sector also, just due to the fact that people are worried about a major recession, if not a depression, if there was in fact a bank contagion, much like 2008. I do not believe that has happened. Silicon Valley Bank is a very niche type of bank. Made a lot of money for many decades. I did an entire 45-minute podcast on this. You can go to shepherdwm.com. It'll take you right to all of our podcasts, including the most recent one, where I go in depth about this specific issue here. And then the markets really, took it kind of in stride, specifically in technology. So the NASDAQ, the tech sector, which is the largest sector of the S&P 500, was positive 5.15% week to date, and is up almost 12% year to date, whereas the S&P 500 was positive 2% for the week and is only up about 2.2% year to date. The Dow Jones was flat this week, and the Dow Jones Industrial Average is actually down about 4% overall year to date. Now, that's what happened. And the reason why the market kind of took in stride is because on Tuesday morning, we had CPI inflation data come in right in line with analyst expectations. The very next day, on Wednesday morning, right as Credit Suisse was coming out with all their issues, we had the PPI, Producer Price Index, came in negative, actually way lower than what analysts and economists had expected. These are all good things relative to inflation falling, which is exactly what we want to be able to see here. And when inflation is no longer the concern, which in my view it isn't, 4.5% interest rate hikes in 2022, going into this year, 2023. That's a lot of rate hikes. That's the most we've ever seen in 40 plus years. And we did the majority of those rate hikes in 6 months. Now, keep in mind, there's a lag effect when you increase interest rates, and that typically takes about a year to 18 months. Well, we've only been increasing interest rates for 1 year. So it took a while for that lag effect to show up, and it started to show up first and foremost in the banking sector with substantial paper losses in bank bond portfolios. Again, I spent a 45-minute podcast talking about those details, so you can check that out. So in spite of all the crazy bond volatility, so we've seen interest rates drop, which is also a good thing for risk assets, specifically technology. So if inflation is no longer the fear, and if interest rates are falling, the 2-year fell over 60 basis points in about a day or two, which we haven't seen that type of bond volatility since 1987, 1982, when we had the 1987 Black Monday, and then, of course, in 1982, where we started to cut interest rates, coming out of the 1980, 81, 82 issue with the highest inflation that we've ever seen in this country. So it's been a long time since we've seen this kind of volatility in the bond market. And typically the bond market is in my view, a cousin to stocks. It typically picks up things a little faster than the overall stock market does, which makes a lot of sense given the fact that that's how a lot of corporate entities raise capital is through the bond market. The bond market is about 3 times the size of the overall stock market. So when rates are coming down and inflation figures are coming down, yes, there was some very bad headlines relative to Silicon Valley Bank, Credit Suisse, Signature Bank. However, those are a lot of isolated incidents. As I mentioned, Credit Suisse is a Swiss bank. It's been a penny stock. They've been a terrible organization essentially for about, since 1970. If you look at their history, very poorly run institution. I would imagine it's going to get bought out by some other entity at some point, much like what's going on here with Silicon Valley Bank and Signature Bank. A lot of very negative headwinds, but actually really excellent economic data. On top of the fact that earnings have been very, very strong. Companies like Adobe announced this week, they actually increased their guidance. They blew away their top and bottom line, earnings estimates. So there's definitely a lot to be very, very excited about. However, everything really hinges upon what Fed Chairman Jerome Powell has to say about interest rates and the overall economy on March 22nd. So Wednesday, March 22nd. He's going to come out at about 2 o'clock in the afternoon Eastern Standard Time and make an announcement regarding interest rates and the economy. And it's not really so much what he does. I don't think he should raise rates at all for a lot of very, very important reasons. Specifically, the stress that the financial industry is actually under, and that in and of itself is like having 2 or 3 rate hikes. Just having banks going through this process of essentially this slowing of growth in the economy, and the less liquidity that's in the marketplace is what increases interest rates. And now they're going to be very, very tight as far as who they lend any dollars to, given the uncertainty of the economy's outlook and what interest rates might look like over the next 6, 9, and 12 months. So again, March 22nd is a very vital day. I don't think you should increase rates at all. If they do increase rates, it's only because they're trying to quote unquote save their credibility, which to me means they're obviously more interested in the social impact as more so than it would be the actual economic impact, which is completely ridiculous for somebody that's in that particular position. So if they decide to pause, I think that you'll see quite the rally in equities. And even if they do increase interest rates, the market's priced that in. There's about a 50-50 chance. The market expects a 25 basis point increase in the interest rate, and then they don't expect any interest rate increases at all for the remainder of 2023. And matter of fact, there's baked in rate cuts to the latter part of the year as we're speaking right now. And that is a dramatic difference from 2 weeks ago, where a lot of very smart people, they get put on TV and these news outlets were calling for, maybe even 6% in Fed funds rate. You saw the 2-year climb above 5% in just a couple of days after everybody, was kind of jawboning the January jobs report as well as the inflation information that came from January. And then that all changed here recently with the issues with SVB, Credit Suisse. And then we actually got, again, really good inflation information. So I think that the lag effect is taking hold in the economy, and you're starting to see all the impacts of that. And unfortunately, it hit SVB Bank first here in the United States, but I do believe it'll be the last bank that'll have these sorts of issues here. And as soon as that contagion risk, if you will, is no longer top of mind headline news every single day, investors can start to begin to look at, okay, what is the actual impact of inflation? Well, it's falling clearly, and it's likely to fall even further based on what's happened here in the financial sector recently. And on top of that, all the housing data figures should start to show more and more disinflation, since that typically has the longest lag effect. Although it hits mortgage rates instantly when rates go up, typically housing has the longest lag effect, and it's also the biggest sector weighting on how they calculate CPI inflation figures. So I'm very, very encouraged at the direction of inflation, which is down. Unemployment is still historically low. And if the Fed chairman decides to not increase rates, I don't expect unemployment to have a substantial spike. Hence, you have a very vibrant economic condition for equities, specifically for those in the tech space as well as in the industrial space, which is a big overweight for us here and our clients at Shepherd Wealth Management. So that's what happened this week. That's why it happened. There's certainly a lot to look forward to. And this is very, very similar, in my view, to what happened in our economy in 1994. So in 1994, we increased rates about 6 times. Going into February of 95, we increased rates one more time. 50 basis points, and then we had 3 cuts into the last part of 1995, and the stock market received that very well, with the tune of 33+% type of performance. Now, clearly, past performance is not a guarantee of future results. However, history does tend to repeat itself, and I'm positioned accordingly for our customers here. So I'm kind of expecting the Fed to take a little medicine here and hopefully have a little bit of humility on this Wednesday's report. And I will be coming out on Thursday on YouTube Live at 11 o'clock a.m. Eastern Standard Time. And I'll be talking about all the Fed decisions from the prior day, obviously what's happening in the markets in the moment. And I'll certainly give my take as well as the historical precedent for similar events that we've seen in the past. And I actually do believe that we'll see a lot of the similarities that we saw in 1994 and 1995. So with that, I hope you guys have a wonderful St. Patrick's Day weekend. Enjoy the college basketball. Don't forget to check us out at shepherdwm.com. We're getting all kinds of awesome feedback from yesterday's live YouTube event where I went over everything related to SVB, Credit Suisse, Jerome Powell, the whole 9 yards. I think you'll absolutely love it if you haven't seen it yet. Don't forget to like, subscribe, hit the notification button so you can get notified every time we drop these. And certainly hope you guys have a great weekend. I look forward to catching up with you next Thursday on YouTube Live. Have a great rest of your evening.